The best macro moves happen when one policy path in a currency looks stronger than another currency. Let me explain what I mean. If two central banks are both tightening interest rates, hiking interest rates essentially, there's not much to do in that pair. Likewise, if two central banks are both easing interest rates, so cutting interest rates, then there is not a policy divergence. But when one central bank moves in one certain direction, maybe cutting interest rates, and another one is expected to either hesitate or even better move in the opposite direction, so maybe in this case hiking interest rate, that's when some of the best trends fall. These exact frameworks were built the AUDNZD trade we took a week ago. The edge here is understanding how we saw the divergence forming before the move actually started to unfold. So today I'm going to show you how currencies trend when policy expectations separate, like it's happened here with the Australian dollar against the New Zealand dollar, how we identify this divergence early, and most of all, how you can repeat this pattern over and over again to take advantage of it. Let me show you. The whole foundation behind a policy divergence is simple. If both central banks are hiking, there is no policy divergence. If both central banks are easing, there is no policy divergence. Now things get interesting when one central bank cuts interest rates and another central bank hikes interest rates. Now let's rewind the context in which we took the Australian dollar against the New Zealand dollar trade. Every great trade starts with a clue essentially. For this trade, the first clue came from Australia, because at that time, Australia was flashing, I would say, resilience, strength. The unemployment rate was actually ticking lower to 4.1% and was expected at 4.4%. Now, follow me here closely for a second. The unemployment rate was expecting to worsen from 4.3% to 4.4%, and yet it actually printed 4.1%. So that's the first clue there. Okay, labor market tightening instead of weakening. That's the first clue. Second of all, inflation started picking up again, popping back up to 3.4%, and clearly above the Reserve Bank of Australia threshold. You know, they have a target range between 2% and 3%. So inflation at 3.8% is clearly above their range. Now, pause for a second. Think like a central bank here. You have a legal mandate to keep inflation between 2% and 3%. Okay? You gotta keep inflation between this range. Now, the labor market is doing pretty well. It's not weakening, so it can withstand a tighter policy rate because it's not actually, at the edge of a recession. It's doing pretty well, so there's no need to supporting, but inflation is running at 3.8%, above your threshold. What do you do here? Do you start talking about easing policy and cutting rates? Of course not. You will be laughed out of the building if you did that. Your only two choices are either hiking rates or at least keeping them high. Why? Because you want to lower inflation. And so this right here, this was the first side of the divergence forming. Okay, the first piece of the puzzle for this trade to start taking shape. Great, that's a piece of the puzzle, but it's just one piece of the puzzle because divergences require two pieces. So let's go to New Zealand. Now, at the same time, while Australia was having its unemployment rate tick lower, New Zealand was facing the completely opposite scenario, with their unemployment rate ticking higher to 5.4% in Q4, the highest it's been in years. Okay, first clue there's something wrong. Now, I'm hammering this point about the labor market because just like Australia, the labor market is part of the central bank's mandate. The Reserve Bank of New Zealand just cannot ignore the labor market weakening. By law, by mandate, they have to support it. It's their mandate. They're forced to support it. So this situation creates a difficult position for the central bank because inflation is actually not low enough, but yet their unemployment rate is calling for support. So they definitely cannot hike interest rates. On the contrary, with the RBA, they should probably either cut rates or at least keep rates low just to avoid tipping the economy, the labor market, into a recession. So again, in stark contrast with Australia, with the Reserve Bank of Australia, the RBNZ in New Zealand needed to be cautious, while the RBA didn't need to do that because the labor market was doing pretty great and inflation was well above the target range. So Australia, strong and tight, likely to hike. New Zealand, weak and hesitant, likely to keep rates low, maybe even potentially cut rates. But we don't know exactly. But we know that at least they're gonna keep rates low and definitely they're not gonna hike yet. In other words, while the Reserve Bank of Australia was being forced to hike, the RBNZ was being forced to be cautious. And so at this point, markets began to realize Australia would likely maintain tighter conditions longer than New Zealand. In other words, interest rates in Australia are likely going to be higher than New Zealand, going higher compared to New Zealand. So the yield differential was going to move in favor of the Australian dollar. And so the opportunity formed for AUDNZD to continue higher. Why? Because capital were going to rotate into the Australian dollar relatively to the New Zealand dollar. Perfect. We have a bias. So we know we want to be long the Australian dollar against the New Zealand dollar because the Reserve Bank of Australia will hike interest rates while the RBNZ hesitates. It's a policy divergence. Macro context is set. Now the next step is to look for a technical trigger. And this is where it gets very straightforward. You do not need to complicate. Simplicity here is what works best. When you have a strong macro trend to trade, the technical trigger can be, and I would say should be, incredibly simple. All you need is for the chart to tell you that other people are starting to pay attention to the story that you have figured out already. Okay? I myself personally look for simple market structure on lower time frame like the hourly chart and price action on higher time frame like the daily. But in this case, the market structure on lower time frame was enough for the trigger because look at the trend line. Look at this trend line coming from here, 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 resistance here as well. Suddenly it breaks, it starts to break higher, which obviously is a signal something on the chart is changing, that the bulls are starting to recognize that the fundamental context is bullish, and this is a perfect technical trigger that tells us essentially that the market is ready to pay attention to the macro sentiment. It's ready to resume towards the macro direction. And so this gives us an opportunity to enter into the macro trend, and that's where you enter. Now, where do you place your stop loss on this type of trade? Well, you just simply place it below the structural low that formed before the breakout. Now, if you want to be a little tighter, you essentially could place it here, but I like to give breathing room to the trade, so I place the stop loss here so you can clearly define the risk. If that low gets taken out, the thesis is likely wrong for now and something changed. And for the target, just look left on the chart. For instance, there is this resistance level here, which for me acted as the first place to start moving stop loss to break even, and then another resistance level. If you look left on the chart, was a historical resistance level. Now the point here is there's no secret indicators here, there's no hidden strategies. It's just a powerful macro bias, the fundamental context confirmed by what? Simple price action, simple market structure breaks. Now I want you to understand this clearly. This trade that we took is done. It hit take profit already. But the pattern is not done. I mean, macro divergences repeat over and over again. One economy weakens, one stabilizes, policy paths separate, they diverge, capital rotates, and trends form. This is a macro pattern. And so the hedge here is recognizing the opportunity early and taking action on it. So let me make this practical for you. Here's where you watch to spot a monetary policy divergence early. You watch for two pieces of data that make the central bank's mandate: labor market and inflation. If you spot a divergence in the data between the two economies, you also spot a divergence in the central banks, because monetary policy follows data. Central banks react to what the data tells them to do because they have to follow their mandate. In other words, you need to learn to think like a central banker when you look at the economic data. Understand their mandates, stable inflation, support the labor market, and when you see the data that puts pressure on one central bank to do something and another central bank to do something else, then an opportunity is in the making there. You're seeing a high probability trend in the making. So watch inflation, watch labor market, and understand the divergences between these data. And when policies diverge, we have an opportunity to take, okay? Like we did with the AUDNZD law. So there you have it. This is the framework to trade monetary policy divergence, okay? Look for who needs to be hawkish and look for who needs to be dovish. How? With the data. With the data, the divergence in the data that, most importantly, matters for the central bank, okay? Inflation, labor market. This is the divergence blueprint, which leads to these type of trends and trades that you can take advantage of. Now, it takes a bit more work than following a technical indicator, I know, but the quality of trends you will catch is on another level entirely. So if this video helped you in any way, then do me a favor and hit the like button below. It's the best way to let YouTube know that I should make more videos like this.